Hi there. Are you over 65? You could be missing a big 2026 tax reliefs which you can claim. Stay with us and we will explain it you.
Hello and welcome. We know that in 2026, the tax landscape for UK seniors is in for a bit of a shakeup. And understanding these changes is absolutely crucial for protecting your retirement income. So in this session, which has been developed by the expert tax advisors at Tax Accountant, we're going to break down everything you need to know.
Right, let's start with this number, £22.40. It seems tiny, doesn't it? But that small, almost invisible amount is the line that will separate thousands of pensioners from paying tax for the very first time come 2026. It's a bit of a financial tightrope, really, and we're going to show you how to walk it.
So here's the big question. Your state pension is going up, which sounds like great news. But is that extra cash a real gain? Or is it more of a Trojan horse quietly pulling you into a tax bracket you've never had to worry about before? This is what's being called the pension squeeze. And honestly, it's a hidden trap that could catch out millions.
Okay, so here's our plan. We'll start by really getting to grips with this pension squeeze and what it means for your finances. Then, we'll look at some new rules for investments and a really critical $35,000 cliff edge for the winter fuel payment. But don't worry, we'll then shift into solutions, uncovering some hidden allowances and practical steps to safeguard your retirement.
It really is a classic case of giving with one hand and taking away with the other, isn't it? The government is boosting your pension, but at the same time, they're not increasing the tax-free bucket you can put it in. This is something called fiscal drag, and it acts like a silent thief, just slowly and quietly chipping away at your income, all without any headline tax rates actually going up.
So this is the heart of the issue. Right here. On one side, you've got your pension rising, getting that 4.8% boost. But on the other, the tax-free allowance is completely frozen, locked in place for years. It's this financial pincer movement that's squeezing pensioners' finances tighter and tighter.
So, let's get down to it. How close are you to that tax-paying edge? For so many people, the pension increase isn't just a bit of extra cash. It's the final little nudge over the tax-free threshold. And this catches a lot of people out. People who've never had to file a tax return in their entire lives. This is where it gets real.
As you can see, in 2026, the full new state pension will rise to just shy of £12,500 a year. Now, on paper, that's a decent cash boost, driven by that 4.8% rise in average earnings. But as we're about to see, it really does come with a hidden cost.
And there it is. The gap between the personal allowance, what you can earn tax-free, and the new state pension has shrunk to just £22.40 a year. That is such a tiny sliver of daylight, leaving almost no room for any other income at all. The state's main retirement benefit now uses up pretty much the entire tax-free allowance it provides. It's incredible, really. So here's our pro tip, and this is the crucial point. If you get the full new state pension, literally any other taxable income could make you a taxpayer. Think about someone like Margaret in Bristol. She gets her state pension, and she also has a small private pension paying her just £5 a week. That little bit extra, £260 a year, is more than enough to push her over the £12,570 threshold, triggering a tax bill she's never ever had to deal with before. But the government's hunt for revenue doesn't just stop at your pension. Oh no. In 2026, they're also turning their attention to your investments. Now, this is a major blow for retirees who rely on things like dividends and capital gains to top up their income. So stay with me here, because this next part affects nearly everyone with savings.
Let's make this simple. From April 2026, the tax you pay on dividends is going up by 2 percentage points for both basic and higher-rate taxpayers. That is a pretty significant hit for anyone with a share portfolio that's held outside of a tax-free ISA, and believe me, it can really start to add up.
And you guessed it, it's a similar story for capital gains. The tax-free allowance for when you sell assets is staying frozen at a really meager £3,000. And for those of you who might be planning to sell a business to fund retirement, there's more bad news. That special low tax rate you could benefit from is being hiked from 14% up to 18%.
Okay, now for a bit of a winter shock. The government is overhauling the winter fuel payment, and a new cliff edge rule means many people are going to have to hand the money straight back. You'll absolutely want to hear this part.
This quote really says it all. The new system isn't a gradual taper where the payment slowly reduces as your income goes up. Not at all. It is a hard, brutal cliff edge. If your total taxable income for the year is just one single pound over the new £35,000 limit, you will lose the entire payment. Just like that. So what does HMRC actually count towards that limit? Well, their definition of income is pretty broad. It includes your state pension, any private pensions, earnings, dividends, rental profits, pretty much everything. The only real safe haven here is any interest you get from your tax-free ISAs. So here's how this clawback actually works. First, you get the payment automatically, just like you always have. But then, at the end of the tax year, HMRC tallies up all your income. If you're over that £35,000 limit, they will take the money back, either by adjusting your tax code for the following year or by adding it to your self-assessment bill.
Right. Now that we've mapped out all the challenges, it's time to arm ourselves with some solutions. The tax man might be squeezing, but there are some fantastic hidden allowances you can use to push back. A lot of people just don't know these exist because, well, you have to actively go and claim them. So it's time to go on the offensive.
First up, let's talk about the marriage allowance. This is a really powerful tool for couples. If one of you earns less than the personal allowance, you can transfer £1,260 of your unused tax-free allowance over to your partner, just as long as they're a basic rate taxpayer. It's a simple but really effective tax break.
And what's the bottom line? Well, claiming the marriage allowance can cut your partner's tax bill by up to £252 every single year. It's a straightforward, valuable saving that an astonishing number of eligible couples simply fail to claim. Don't be one of them.
Now, for older couples, there's something called the Married Couples Allowance, which can offer an even bigger tax break. If one of you was born before April 6, 1935, you could claim a tax credit worth up to £1,170 a year. The full amount is available for those with an income under £39,200.
The blind person's allowance is a true game changer. It adds a whopping £3,250 to your tax-free allowance, which brings your total up to over £15,800. And what's more, if you don't have enough income to use it all yourself, you can actually share the unused benefit with your spouse. It's incredibly valuable.
Okay, so we've navigated the pension squeeze, we've dissected the new rules, and we've uncovered some reliefs you can use to fight back. In this new era of retirement, proactive planning isn't just an option, it's really your best line of defense. So let's talk about what you need to do next.
Now, a quick but very important note. The information we've talked about here is for general guidance only. Everyone's tax situation is unique, so please don't make any big financial decisions based solely on what you've heard today. It is always best to consult a professional who can tailor their advice to your specific circumstances.
The 2026 tax changes are definitely a challenge, but with the right advice, you really can turn them into an opportunity. It's about taking control of your financial future today. For personalized, one-to-one advice, get in touch with the expert team at Pro Tax Accountant using the details you see on the screen. And for more insights like this, don't forget to subscribe to their YouTube channel. Thanks for watching.